We have Christian Bendixen here for more on the dollar's course and whether it can move with the markets as well. He's the Director of Technical Research at Bay Crest Partners, and he joins us on set. Let's talk, Christian. First of all, welcome. Thanks for joining us so close to the holiday. Excuse me. Let's talk first of all about the dollar. It's been gaining momentum lately, and we've had recently a lot of big names come out. Barton Biggs, Mark Faber say they think it's going to continue to rise, and you agree. Why?
There are a lot of variables in the dollar. I think the most important one in the next few months is that we're seeing real evidence of bona fide economic growth, and I think that's going to help push the dollar higher. And I think that's also the reason equities and the dollar can push up together.
Does the Fed have anything to do with it as well? All this talk now that the Fed's going to start absorbing this excess liquidity injected at the height of the crisis?
Yeah, I think the sooner they start removing some of this excess liquidity, the higher the dollar can go. I think that we're pricing in an increase in rates as well towards the end of next year, and I think that's also going to help the dollar. The other thing, if you look at Europe, is there's a lot of sovereign risk coming out. We saw what happened in Greece and Ireland, and I think that's going to hurt the euro and going to help the dollar as well.
Could it be, though, bearish, sorry, Matt, for the dollar, though, if the situation in Europe and Eurozone, those situations with the sovereign debt turn out to be not as bad as we initially thought they were?
No, I think now there's more investor concern and there's more flight to safety, and so more investors are willing to buy dollars as a flight to safety trade.
I wonder why, though, if the Fed's pulling out liquidity, and a lot of people have said that last year or this year was a liquidity-driven rally, and also the carry trade will be taken off if the dollar gains strength, obviously. Why do you think that equities would rally with the dollar?
Again, I think the most important driver of the dollar is going to be bona fide economic growth, and the more evidence we see of that, the more the dollar can go higher. And if that's the case, then equities can go higher as well. In relation to the carry trade, we've never been a big fan of the carry trade. You know what they say, it's like picking up pennies in front of a steamroller. It's very easy for the carry trade to unwind rapidly, and we're seeing evidence of that. We're seeing really tremendous volume as the dollar starts to bottom, and I think you can get a big short squeeze.
Okay, so in some of your recent research, you say equities are in the topping process for an intermediate top, though. So your outlook here, as you're telling us, is very bullish, but it seems like it's short-lived.
Right. So, we always differentiate short-term and intermediate term. In the short term, over the last few weeks, we have been arguing for a final leg up in equities. And so our target in the S&P is 1160 to 1170. However, at the same time, we're arguing that it's a very weak move, a very weak technical move in equities. And so we think that we've started the topping process, and we will get another 5 to 7% higher in equities, but at that point, somewhere around mid-January, end of January, we'll get a sizable correction in equities before we can go any higher.
You're going long, though, some select sectors, and I noticed that semiconductors is one you've added. Do you hold that long position even if you decide to go back to short the S&P?
Probably not. We expect another, the semis trade has worked well for us in the last 2 weeks. We expect about another 5 to 7% upside in that trade, and then we'll probably take it off.
And you've got a long position in utilities, too. That's a little defensive.
That is. So basically our strategy over the last few weeks has been to identify sectors that have an attractive risk-reward vis-a-vis the S&P. And so utilities and S&P had broken above critical long-term pivot levels, consolidated, and we felt that it was an attractive trade. And the fundamentals were there.
But you expect continued strength in the dollar. I mean, even though you only have a short-term bullish position on the equity markets, you have an intermediate bullish position on the dollar. So you think the dollar will continue to gain strength as the equity market comes back down?
That's right. We've been arguing for the bottoming process of the dollar actually since September. And now that we've added a major structural long trade on the dollar, we're going to keep in it. We have no interest in trying to trade around that. At some point, for example, if you look at the DXY index on the dollar, it will go from about 77, 78, all the way back to about 76, in our opinion, before we can move higher. But we're not interested in, getting in, getting out. So we're just going to maintain that position for the next few months because we do expect another 15 to 20% upside in the dollar, and I think we can go above last year's highs.
Last question, couple seconds. Any industries or even asset classes to steer clear of in this climate?
Treasuries.
Really?
No doubt.
Okay. Well, I guess interest rates are on their way up these days. Thanks so much, Christian Bendixen. Appreciate it.